the Friday sell-off, as much as I still feel somewhat dismissive of it and sort of just see it more as manipulative than anything. But I do think you make a good point that it indicates the amount of sort of soft tissue that lies underneath these levels. And you can see the chart today, which kind of shows you the same thing. And basically, I mean, you can make a case that the market is showing evidence of its fragility, I guess, would be the sort of, whether it's the Friday whiplash or the behavior today. I mean, it sort of brings up, let me put it this way. I feel like it's an interesting time to speculate on things that might be vulnerable to giant sell-offs.
Yes.
Like if you were to kind of try to position because it seems like there's going to be more, even if they last an hour or a day, we've sort of opened a window where you're going to get some sort of bombing runs to the downside. And I guess the question is sort of whether there's a way you can strategically position yourself to increase the probability that you might be in the right place when it happens.
It's a very interesting thing, and I think you make an excellent point. I mean, we don't have a convincing reversal. What we have is a market that has kind of revealed itself to be, if nothing else, scared of its own shadow.
Exactly.
And it's not like it's walking down a dark alley and it doesn't know if anything is going to be the matter, but it's concerned. And when something goes bump or there's a weird shadow that comes across the wall, it all of a sudden starts to panic. So there's a sense of unease.
When it starts to panic, where is that? Like, I mean, right now, I guess the obvious place is we're just looking at the index charts because it's sort of whether it's an S&P swoon from Friday or just the sort of weird candle up and or down and around the horn today kind of thing.
Yeah.
I don't know.
This is a perfect time.
Has volatility expanded along with this?
It has, and so. Certainly worthwhile to have a look here, but what a perfect segue to take a look at the sector performance today. The only sector with meaningful losses today is the super glide contingent. So technology down today, and everything else looking pretty solid. 1.5% for staples, 1.1% for financials. Not surprising. Financials had pretty good earnings reports, and I know Thomas is on top of it. He wrote the report, so he'll explain these to us surely. Industrials up 1.2%, materials up 1%, real estate up almost 1%, utilities up 0.75%. It's not a bad mix, but the technology side of it is just such a huge sucking vortex of market cap that if it's having a bad day, it's really tough for the market to do anything but show losses.
I mean, listen, there's a bunch of ways at this. The obvious thing is take the highest beta names and at the very least take advantage of the volatility and maybe sell some sort of with room to, well, God help you. So this could be a little madman's delight. I got to be careful what I say, but take the super high beta names, take advantage of the high volatility, and maybe ease into a few call spreads a bit north of things and see if you can get a combination of compression. Anyway, the other thing I was thinking sort of contradictory, maybe not contradictory, but is just old school tasty, that take advantage of the expanded volatility, even if it's a condor on an index. Again, it's sort of like the whole thing with the conversation we have about getting short oil and whatever the things are, right?
Sure.
Timing
Yeah.
is everything. And so it's like, obviously it's easy for me to sit here and say, oh, maybe you sell some volatility here. But then again, it's things, it's only this thing's only just started.
Well, and this is where it gets interesting. So if you look at, I mean, we just said tech was the the problem child today. If you look at who had the biggest losses, it's not the names you want to see. Intel, Nvidia, Oracle, SMC. These are not names we are unfamiliar with. These are sort of right there in the supernova contingent. So these are not things you want to see down when you consider sort of how important they are for the overall landscape, because there's, again, so much market cap in this story. Thomas, talk to us a little bit about these bank earnings, because as far as I saw, they all beat but for BlackRock, which missed by a little bit. But the performance was kind of a mixed bag, right?
I mean, if you're looking at the big ones, J.P. Morgan, Goldman, Wells Fargo, Citi, I mean, they all did pretty good. I mean, most of them beat their numbers on revenue, EPS. Jamie Dimon's comments were something like, the labor market has softened a little bit, but the U.S. economy is still resilient. Spending is still pretty high, and I think Goldman or Citi, whoever has a bigger credit card portfolio, they said spending on credit cards is increasing. I guess you could look at that two ways. I mean, more people putting things on credit, but nonetheless, spending is staying resilient. The labor market, soft weakening isn't eating into margins yet. Things like that. I think Wells Fargo did the best, but that makes sense because they've been the laggard. And that's one of the strategies I've been kind of playing with the past couple months is, these laggards, when the market goes down, their performance isn't matching. So they go down less than, these big names like the Mag 7 stocks. That's kind of exactly what we've seen. So one thing I've been doing that on is Tesla for the past few months, selling put spreads on it. But yeah, all the banks, pretty okay numbers, stronger than expected across most of them. Wells Fargo having the best performance, but that makes sense. It was only up 11% year to date versus the 35% for JP Morgan, Goldman Sachs, things like that. So, the banks, they usually kick off the earnings season, and now we'll be going into the more tech stocks next week. So, I mean, all the market is weighed down. We got the Friday, the trade war stuff, a little rebound Monday, and then today we are failing to recover those levels. I put on a iron condor one day in the ES today, just assuming we'll kind of kick around in this range for at least until tomorrow. So that's kind of the way I'm playing it.
One interesting thing as far as performance today, I mean, obviously NASDAQ soggy when tech is having a bad day, but one place where you don't see weakness is the Russell, because of course all the other sectors are up. So there's something to be said here for small cap resilience. I mean, here we didn't have the breakout to record highs that we had in, let's say, S&P. So this breakout, note, right, this is the high from sort of the post-Fed high. If this is the Fed right here, this is the 17th. The market generally kind of drifted in the wake of that event risk. That's the high. The S&P set a higher high. NASDAQ obviously set a similar higher high. So again, there's that same range top. It set a higher high. Russell did not set that high, but it is certainly holding up better today. So here's that same range top. So whereas NASDAQ was able to get up here, then down, S&P up here, then down, this didn't get all the way there, but it is looking a little bit better today, but it's struggling to get any sort of lasting extension here. It's again stuck at this range top. And if you want to be mildly technical about this, these are higher highs. So that's a little bit higher than that. This is a little bit higher than that. Meanwhile, this momentum indicator, and I have RSI here, but you can use whatever you like. Name an oscillator. It's all good. It's fading. So despite the fact that we're setting higher highs, momentum is easing off. And were Chris here and had a different oscillator on here, it would show the same thing. So
isn't the other version of this buy the dip? And let's not throw out the script that's been working for years.
Sure. And I think that's maybe where this gets interesting, is if you take today's price action at face value, you go, okay, there's maybe some kind of a problem with tech, but looking at the Russell, there's a degree of rotation. So maybe what this is a spread idea. Maybe this is a long Russell, short NASDAQ kind of an idea, where market cap basically just moves. There's too much froth over here. There's maybe not enough love over there. We'll surely talk about what Powell said momentarily, but his vibe was certainly not negative on the economy as such. So looking at sort of short overvaluation, long the economy that isn't broken, would be a kind of long Russell, short NASDAQ kind of an idea. Mm-hmm. Now, that's today. If you wanted to say, you know what, actually, the Fed is cutting for reasons that are growthy. In fact, they're talking about the labor market has shown signs of weakness. That's how we justify the September cut, et cetera, et cetera. So maybe we don't want to be growthy. Maybe it makes sense that Russell didn't make this higher high and that it's still stuck here. And maybe actually the old narrative is the one that's right. Maybe this is a buy NASDAQ, sell Russell because this is on discount and Russell clearly isn't.
Yeah, I think I don't know if I'm buying Russell right here. I mean, the trade tensions are heightened. You know, we had a slight walk back if you look at Trump's tweets or truths, but you know, he just came out with another truth shortly before we went on that is saying that China is committing an economically hostile act by not buying soybeans. So, I mean, that's been a major sticking point in the thing for farmers, you know, bankruptcy.
If only they bought the soybeans, everything would be all good.
So now he's threatening to not buy used cooking oil, UCO, from China, and saying we can produce that ourselves. So, you know, used cooking oil, it's not used for things like, you know, you buy in the store for your cooking oils. It's used for, it's already used. So it's used for things like biofuels and things like that. You can't immediately, you know, we already plant more soybeans than we need. If you need to plant more, you need to displace other crops. It's a little hard to do. So we can't necessarily replace UCO immediately. So it's kind of an empty threat, but it's him messaging that, you know, he's not happy, or, you know, the rhetoric is increasing. So I'm not sure if that tweet's going to put the markets more on edge. You know, you get that effect of the first tweet, you get a big market reaction. The next one, you get slightly smaller market reaction. Then it goes on and the market kind of, you know, it fades until you see more tangible things that are reported. But nonetheless, it still seems like this isn't quickly resolved or going the taco way or anything like that. So
the tone is interesting, though, right? Like Friday, it was 100% tariffs, everything. Now maybe we're not going to buy any used cooking oil.
Yeah,
it's like, well, clearly the level of impact here has kind of gotten walked back. And Besant was out there yesterday. Jameson Greer, the USTR, was out there today. both saying, yeah, you know how the president said that he's not going to meet with Xi when they're both at the APEC summit later this month? Yeah, don't worry about that. They're going to meet. It's going to be fine. In other words, both the Treasury Secretary and the USTR are out there saying, you know how the president said something? Don't listen to him.
Yeah, I mean, we've seen it before. I mean, it's kind of the same playbook in a different way.
Yeah. Yeah, I mean, that's a very strong point. I mean, if you're concerned, and I think you'd be rightly concerned, that we're back into a trade war type of escalation with the U.S. and China. We had been kicking this can down the road, but now it looks like everybody wants to get feisty. It's not like China took these comments from Friday lying down. Their response was essentially, this is not okay that you're saying this. It's not okay that you're doing this, and we're not going to sit idly by. We're going to respond. So if you do stuff, we'll do stuff back. So a defiant response, if you will. Everybody's kind of walked back the tone a little over the past 48 hours. But if this is a trade war escalation, then anything growthy is going to be front and center on the downside. So one would be better positioned then of our options here to say, okay, well, maybe there's a reason this didn't set a higher high. Maybe there's a reason why it's getting stuck inside this range. Maybe actually NASDAQ, which doesn't care terribly about this part of the equation, at least to some extent, or at least to the same extent as the Russell, maybe this is on discount. But it's difficult to make that case when you have this crystal clear range right there. It gets cut through, and when we come back, we retest right there, but we can't make it back over. It just positioning wise, it looks nasty.
What if the most predictable thing right now is a sort of elevation in Trump madness? To Thomas's point about the soybean thing, but whatever is going to happen here, that it's more likely than not that Trump is going to become more active and more aggressive. He's feeling really good about himself, understandably, coming off of the truce or the ceasefire or the end of the war in Israel and Palestine. And he's already, he already sort of indicated his state of mind with the, he's sort of feeling godlike. And so it just seems like he's in a good position to say and do all kinds of things over the next few weeks, as he sort of views himself as the king of the world.
At least polling wise, looking at where we are, we've seen his numbers with the population improve a little bit over the course of the past 2 weeks. So over the past 2 weeks, he hit a disapproval spread of almost 8 points. So his poll numbers not great, and that was the worst that it had been basically since the beginning of the year, so since he got back into office. So his popularity is fading. But over the past 2 weeks, things have improved a little. And so now he's down to a deficit of about 6 points. But the tide polling wise has been against him, though understandably, to your point, over the past 3 to 5 days, he should be feeling very good about himself.
Yeah, I mean, and I don't honestly think he cares about the polls. I think he just sort of relishes the attention. But I mean, I think the obvious punching bag for him is going to be China.
Yes.
And so if China-based volatility is in the mix, where does that play out, right? But like Nike, for instance, got face pounded on Friday, right? Or it's just sort of like it's like the China, getting positioned both long and short, but just sort of being, if they're up, they're going to go down, and if they're down, they're going to go up, kind of thing, with any of the China or China derivative. To Thomas's point about the soybeans, that may be the place where there's the most. The most predictable thing is Trump's going to say wild and crazy things. The place where he's most likely to say the wildest and the craziest things is around China.
Sure.
And so China or China derivative trades are the ones that are going to have the most direct volatility from potential upcoming Trump madness.
To your point, FXI, the China large cap ETF, had a abysmal day on Friday. No big surprise there, but very soggy in its recovery here. I mean, obviously it had the same sentiment recovery that everywhere else had, but very soggy. If we look at ASHR, which is the broader CSI 300 ETF, I mean, obviously it's not very liquid, so this chart's a little fuzzy, but we can see here there was your consolidation range, ugly Friday, and then we're sort of meandering, but there's no real meaningful attempt at a recovery here. Looking at the mags as a group, we're basically back to within a hair of the bottom on this Friday move. So whatever breakdown we had right here, it's holding. So where this gets interesting is, I mean, you have this very clear concern growth-wise. You have a very clear sort of pocket of valuation where you've had a lot of outperformance in tech. What's interesting is that they're different pockets. The China story is a growth story. The NASDAQ story is an AI optimism story. And one of them maybe presents a risk, but at least looking at it today, it's the tech side of it that got taken to the woodshed. Whereas Friday, clearly the catalyst was not that. And so it sort of once again leads me to this way of thinking of going, is the market just looking? Like, are we now in a place where the market wants a reason to sell things, wants a reason to de-risk?
Can't all of those things be true at the same time?
Yes, absolutely. I think that might be the worst of all possible worlds, is that if the market is out there looking for reasons to sell, it'll find them. It doesn't have to find them over here. It doesn't have to find them over there. Oh, the president said something wacky. Okay. Oh, the president took back the wacky. We're not going to come back. Oh, there was something bad on growth, or Powell said something odd, which he didn't. But who knows? Tomorrow, the sort of anti-Powell speaks. We're going to have a speech from Stephen Mirren yesterday. Who knows if he's in agreement with himself at this point? Last time we heard him speak, he was opposed to everything that everybody else on the FOMC was saying, and also things that he himself was saying. So it's interesting. He's a contrarian's contrarian, apparently. But he's going to be speaking. We'll see what he says. Powell was non-controversial in his remarks today. Nothing especially crazy there. He did say, perhaps the markets liked this, that the end of balance sheet contraction is coming in the coming months. So a level of tightening is going to go away, sort of background tightening via the shrinking of the Fed's balance sheet, but ultimately nothing too crazy. It was just very curious that the markets ostensibly did not have a tech-based catalyst today, and yet that's what got taken to the woodshed. And so it's interesting that sort of we try to find what the narrative is, but it may simply be, what can we sell today?
I mean,
And
that's what
curious.
happens. I mean, if
Yeah.
you're investing or trading the ones that are gaining the most, when the pain point comes, that's what's going to be easily sold.
Exactly. I think that's spot on. And so it's very interesting for me from that sort of exact perspective, right? We got to walk back in the trade war. The growthy trade war sensitive index, the Russell, actually outperformed today. The president is talking about used cooking oil, whereas on Friday he was talking about blanket 100% tariffs. Besant and Greer are out here smoothing things over. Markets obviously noticed, hence the kind of growthy mix of what's up and what's down. None of that, there was no tech earnings. Nothing bad happened in tech ostensibly today, not that I saw. So it was interesting that the market was like, okay, but we need something to sell. What can we sell? And so that's an interesting mindset emerging, because if what Friday told us is that the market is no longer resilient in the face of all headlines and sort of appearing more fragile, this kind of behavior starts to look like, well, people are just looking for upticks to sell.
We're 1 week away
as opposed to dips to buy.
We're 1 week away from tech earnings kicking off. Netflix. And then we got Tesla Wednesday, Amazon, Intel Thursday. So is this, do we gyrate sideways
maybe
until Tuesday? Yeah. What's the next catalyst?
Therein is the most fascinating, I think, thing here. And it goes directly to Dylan's point. The likeliest catalyst at the moment is that the president says something that the markets don't like. Because there's no economic data. There's no third-party economic data or private sector economic data of substance that's left on this calendar really for the remainder of the week. There is next to nothing here. So, I mean, I guess there's some stuff overseas. We've got a little bit there, I suppose. But it's really slim pickings. I mean, Chinese inflation data is due. As I mentioned a second ago, we have the Mirren speech tomorrow. But for the most part, it's pretty quiet for the remainder of this week. The only kind of real catalyst that we had that was anything of substance was the Powell speech, and it passed ultimately, I think, without incident. So that aside, there's not a whole lot that's here for the remainder of the week unless the president says something that the markets find untoward, or I guess sort of in the same vein, we might get the end of the shutdown. And then maybe we'll get some data.
And the risk of Trump saying something is increased when he has, I guess you say, more political capital. To what Dylan said.
He's certainly feeling himself. And rightly.
And the target is China. I think the question is, how do you get yourself into short China or China adjacent names in a way that's risk managed to get the highest beta when he shoots his mouth off?
Is the market...
One thing you could do is look at currencies. And I know it's going to shock everyone that I want to look at currencies. I mean, when has that ever happened before? But the thing that I'm looking at here is the Aussie, which has been performing much, much worse than pretty much any other expression of the dollar. I mean, it was the only one that got beaten up on Friday, whereas the dollar was down everywhere else. And it's because, I would argue, of the China sensitivity. And so if you wanted a way to trade this without fighting the stock market, you could just be short the Aussie as a kind of, as a proxy bet on US-China shenanigans.
I mean, Australia exports a lot to China, so it's
their number one market.
You can call it a China-linked currency, essentially.
Sure.
Commodity-linked, China-linked.
All those things, yeah. All those things. I mean, basically, the business model in Australia for decades now has been go to Western Australia, dig up anything you can, load it up on a barge, send it to China.
Iron ore, gold.
Yeah, iron ore, coal, for the most part. But if it can be dug up in Western Australia and loaded on a ship, do those things.
I mean, does it really need to be that linear? I mean, if he's going to throw around 100 of these mega tariffs, doesn't that hit Amazon and Nike and Costco and Walmart? Like, I mean, it just seems like there's a bunch of people that have problems with 100% China tariffs.
I would agree. And I mean, there
percent or whatever, you know, like just any sort of like, or ban the port, close the ports.
Yeah.
You know.
Yes, that was the other that was the other that was the other juicy tidbit we got today. The closing of the ports. We do have CSX earnings this week, which should be very interesting in the context of all of this. Right? Because once the stuff gets to the port, it's on CSX and them to move it around the internal US supply chain. And if there's not stuff in the ports, then there's not stuff to put on a train and move around.
I mean, because normally we would be in a moment where the dominant discussion and the dominant market function is the earnings cycle or the earnings.
Yes. Yes.
But it
I would
doesn't
think so.
feel to me like that. It doesn't feel normal to me. In other words, I think that maybe it's because of the government shutdown. Maybe it's because the president's sort of propensity to stick himself in the middle of the markets as much as possible have sort of rendered the traditional sort of earnings dominant 3-week period of time secondary to the president.
Yeah. I mean, it's sort of why I think we had the bounce that we had on Monday. And I think it behooves us to take a look at the dynamics here. I have this handy chart. I just like the way that this is displayed. This is from the Wall Street Journal. So here's Friday, and it's just the way that this sort of presents itself. It's convenient to see. We don't have Russell on here, but we have the other big three. And what's interesting here seems to be, I mean, what's interesting to me anyway, is you look at this and you say, okay, well, obviously here's the Friday unpleasantness. We start the week and we erase maybe about 60% of it. Hover around, and then coming into today, I mean, obviously overnight was nasty. And then we come all the way back and then fade. But relative to where we started this whole unpleasantness, this is the starting line. We're down across the board, and NASDAQ is the one that's down the most. And that's the one where most market cap is. So it's a weak need kind of thing, seemingly. This is not what you want to see.
It's kind of like, you know, the market tanked Friday, then over the weekend Trump seemed to ease back. Is the market tanking? Say if we started selling off, you know, heavy over the next couple of days. Trump comes out, he has to do something to calm the market because all of his allies in, you know, in the tech industry, people with pensions, 401ks, start getting unhappy, right? So is the market dropping kind of a corrective mechanism on the rhetoric? I mean, I think it is. From what we've seen.
It could be. What's the most interesting for me is that the thing that's getting beaten up the most is not the tariff sensitive thing. And so it's as though the market, to your point, Thomas, is punishing the president for nonsense and essentially saying, look, you got to stop. And
I mean, is that what you think happened over the weekend? Do you think that basically he shot his mouth up on the 100%, not really even expecting or thinking about how the markets might respond?
I don't think anybody knew how the markets were going to respond. I think we would have said
the severity, but do you think that what he did was he saw the severity of the response and that provoked him, to Thomas's point, to like backpedal?
I mean, I certainly think somebody told him like, "Hey, look, man, whoa, look at what just happened. You've got to not say things like that." But at the same time, I mean, who among us would have said, reading his post before it came out, that the market is going to care, right? The market has shrugged off this kind of stuff for months. And suddenly on Friday, it decided that the time has come to care. I mean, if you're the president, you could be forgiven for thinking, I'm just going to go out there and stunt on China a little bit, because why not? Obviously, there's not a lot of emotion in this negotiation. I still want my big, beautiful deal with them. I want to be the president that basically says, I renegotiated the economic relationship between the U.S. and China. I got China to balance the scales and to stop doing things that no one likes them to be doing. I mean, it took Obama and Biden endless arm twisting to get Europe to get tough on China. And Trump too. I mean, it took them forever and a half to convince Germany, to convince the French, but mainly Germany, and certainly to convince the UK. I mean, the whole Huawei 5G thing was a very tough sell in Europe to get them to shun Huawei. That was, I mean, over multiple administrations. But now there's pretty much consensus. So the president surely would love to go, you know what? I stopped the Israel-Hamas thing. I got a trade deal with China. His border policy is ostensibly working. I mean, we can debate as to whether what he wanted to achieve is the thing that we wanted to be achieving, but what he set out to achieve, he's achieved. I mean, the border is basically closed. Border crossings are essentially non-existent.
And so, Powell keeps noting on that for the labor supply.
Yeah. I mean, we keep saying, well, the labor market is in this weird place where there's no hirings and no firings. It's like, well, that's probably, at least in part, explained by the immigration situation. But there's no one to hire, and so I mean the market is tight, but it's not as it were exuberantly looking. And maybe there's not anyone to look for.
There was a large Bitcoin short position added right before the Friday tweet.
That's
No, I saw. I mean, that's why my sense of the Friday tweet, Thomas. I said this yesterday, was that whole thing was just an insider trading kind of racket. You know what I'm saying?
Mm-hmm.
Not that the motivation for the tariff threat was that, but that the people around that information are very cavalier in their use of that information before it gets made public. But, you know, I mean, I think that's kind of par for the course. I mean, this is a presidency based on, you know, as many transactions as possible at all times. Whether it's, you know, Eric Trump doing a hotel deal and alongside the peace accords, or a little Bitcoin short action 30 minutes before the tariff threat. It's all kind of the same thing. They must be making
this is
money.
Right. And so this is where it gets interesting. Like, on the one hand, the president would be forgiven for saying, you know what, I'm going to get all the stuff done. I'm going to get the Israel Hamas thing done. He's talking to Zelensky about Tomahawk missiles in a very loud kind of, hello there, Moscow. Do you hear us talking about the missiles that you don't like? Won't you please start talking sense again? And so he's trying to do all the things. I mean, if you think sort of what are his top 3 foreign policy objectives, it's ending the 2 wars and a deal with China.
Mm-hmm.
So if those are the 3 things, he's got one, unless it backslides on him, but so far at least, he's got one.
Mm-hmm.
He's trying very loudly to get the second.
Being
the strategy of browbeating Zelensky didn't help. So now he's best friends with Zelensky, trying to spook Putin, see if that works. A trade, why not go and stunt on China a little bit just to make sure that they remember that, hey, we're not distracted. We want this thing done. Who would have known that it would have had this kind of an effect? We certainly wouldn't have guessed it. But then the flip side is, well, maybe the effect was welcome. Maybe somebody was there saying, you know what, we're going to put this thing out, and maybe there'll be a sell-off, and maybe not. Maybe lighten up a little.
Mm-hmm. I mean, what is the China deal? Like, what kind of a term sheet? What kind of a deal do you think that they're like? What are the first principles of the deal that they're looking to get with China?
I think there's a couple things. I think they want China probably to do something about forced technology transfer. And in the president's kind of mind frame, if you take it at face value, he seems to think that the existence of a trade deficit is somehow a bad thing. That a trade deficit is necessarily indicative of the side with the deficit losing and the side with the surplus winning, which of course is economic nonsense. I mean, I have a 100% trade deficit with the gas station down the block from my house. I don't sell them any market analysis at all. They just sell me gas. How terrible. So it's a curious thing, but he seems to think that way. And so there's probably some sort of market access for American farmers, more importing of American stuff to work that deficit down, though of course last time it didn't work in sort of administration 1.0. One could in fairness, blame COVID and say that, they had a phase 1 deal, but then once the president started calling it the Wuhan virus, nobody wanted to deal about anything anymore. And the soybeans that were supposed to get bought didn't get bought. But it seems like what he wants is to renegotiate the balance of power and basically say, like, look, we tried to get you into the WTO and you wouldn't be nice about it. How about you sign up? Forget the WTO. How about we just get a list of obligations that you owe us now to kind of rebalance the scales? Maybe some anti-dumping rules. So maybe some rules about rare earths access, that kind of thing. But I think the president would be very open to having all kinds of conversation were there conversation to be had. And I think maybe he's lashing out because it's not being had.
I'm just trying to think, like, say what you will, Trump for sure will get something done in all three of these places. And again, how sustainable it is, all the rest of it. But I tend to think all those headlines are market positive at the end of the day. Like a Ukraine peace deal, like it sort of brings me back to, instead of sort of goofing around trying to figure out where we're going to get slammed along the way, just buy the dip.
Yeah. To that point, actually, one place where we don't have a spirited rebound here is crude oil, which is kind of, I suppose, a growthy conversation and a geopolitical conversation. Thomas, does this sogginess from crude oil tell you, first and foremost, that there's more room to fall, but also that this really is a growth concern that's emerging here?
I think we're going into a new range. So I have an order for an iron condor in between 55 and 62. So we've traded this pretty respected range, staying above 60, going back a few months now. We had, of course, the ceasefire agreement that put a hit on it, but it's also the China news if there's an escalation, economic impact. But the market is already, or has been, looking at a surplus in 2026. That starts in Q1 and increases in Q2. So more supply onto the market. So really, we've been expecting this surplus to happen for a couple months now, but now it's like the market is actually starting to price it in. And falling below 60, you're falling below the price that it's profitable for U.S. producers to open a new well. Existing wells, they can operate down to 50-ish, around there. But, the smaller producers are going to be hurt by this, the ones that have a higher break-even price. So, I'm trading it kind of to go into a new range. I see as, maybe making a move back up to retest 60, not quite getting there because the support just isn't there. If you're looking at, OPEC increasing production, which is mostly led by Saudi Arabia, and they have kind of a backroom fight going with Russia. You also could say they're trying to,
as they often do.
Yeah, and you could also say they're trying to punish U.S. producers as well. But inventories are building. Production is still fairly high for the U.S., increasing for OPEC. There's questions about how much they actually will increase because they have been undershooting their quotas.
As they always do.
Yeah. So, it's really the economy, it's the stocks, it's, a lot of this is the ceasefire deals. Geopolitical premium has come out that was still in it. So that's the way I'm trying to play it, between 55, 60, somewhere around there for the next couple weeks. The order hasn't filled yet. I've had it in for a couple hours now. It doesn't want to fill, but that's what I'm going to get into.
I'm still short here from right around, I mean, essentially this break here. So once this took out the bottom of whatever this range was here and came back to retest, I got short right around here. Not quite the top, but so it goes. And obviously Friday was a very nice tick here in my direction. So I'm holding it for now. I probably don't have much appetite to see it get under these lows.
You know, if you look at the if you look at the term structure, especially almost every contract, if you look at the spread, we're in contango now. You know, whereas a lot of these spreads just a few months ago, were backward dated, meaning the price in the front contracts is higher than the back contracts. Now that has, over the past 2 months, that has weakened. The backwardation has weakened significantly. Now it's contango across most of the curve in 2026. So that's reflecting, you know, the market's view on this surplus market, oversupplied market. So, I mean, that tells me we're not going back into trading or anywhere around 70 or anything like that. And I don't see any scenario where all of a sudden production comes down, OPEC stops, you know, producing, the economy modestly strong, but it just looks like, you know, and if you look at most of the forecasters, EIA, $52 Brent crude average throughout all of the year. You look at Goldman and JP Morgan, they're all in the high 50s, Q1, Q2, Q3 next year. So the forecasters are all pricing in below this price already, but it seems to work. It's all worked its way into the curve for next year.
Very interesting indeed. I mean, obviously, I'm, as ever, skeptical of everything that OPEC does, but to your point, even just looking at the kind of immediate contracts here, you're starting to kind of shift. How do you feel about gold? Obviously, we have an interesting sort of set of circumstances here in the metals. We'll start with silver because it ultimately looks soggier. I mean, obviously, massive surge yesterday and kind of what in candlestick world you would call a doji or a spinning top. So aggressively indecisive, if that's a thing. But gold is a different story. Gold continues to go higher. It apparently does not recognize gravity or macro narratives or the existence of anything at all other than whatever magnetism there is above current levels. Is not buying this the same as thinking? If you're looking at this and going, oh, it's too high, is that detrimental thinking?
I mean, obviously, yes. And it has, and the reason I've made not a penny in gold, despite the glory of this chart, is due to an abundance of thought, all of which has worked to my great disadvantage.
It sort of did for me as well. I mean, I was long silver, but I got off the boat in gold way too early, and got off the boat in silver also too early, although I stayed in that one longer. And it was thought that got me out, and it's thought now that prevents me from buying back in, because you look at it and you go, oh no, you had one downtick. Okay, come on, but it's breaking out and it's continuing.
I got out my gold long last week on the 6th after that nice move up. And then I stayed in silver long via put spread and closed that yesterday. For now, I think these have maybe a little bit frothy, but you know, if they pull back a little bit, I'm going to get long I mean, gold and silver has
I'm
been a
with you.
trade that's worked out time and time again for the past few months. I see no reason to not keep doing it.
I'm with you, but I have a tremendously hard time buying them here, and I realize that's probably a fault of my own psychology. It's thought that's getting in my way of making this gold money. And with that, overtime is out of time. Thank you, as always, gentlemen. We'll be back to this conversation in a mere 23 hours, but don't go anywhere because just moments from now, I'll be back for Macro Money, where we will painstakingly unfurl what Powell said today and what the markets did or didn't do in response, and then take a look at what might be coming down over the course of the rest of the week on the macro front. So sit right there. We'll be right back.
In the world of investing, a beast lurks between the numbers. Some watch from the safety of the sidelines, but others saddle up and ride that one-ton rowdy ribeye for all he's got. If that's you, join us on Tasty Trade, named best online broker for options trading. Genius loves company.
The future of trading is here. Join Mike and his whiteboard, plus the Tasty 2 live crew for 90 minutes of probabilities, punchy portfolio mechanics, and trade tactics. It's totally free and unreasonably fun. Come early to enjoy a drink with the crew and stay for a Q&A after the show. Space is limited, so register today at tastylive.com/events.
Tasty Trade has crypto, and you can trade with zero commissions. Bitcoin, Ethereum, Litecoin, and more. Diversify in one place. Crypto, we got it, we get it.
The market doesn't stop. So why should you? Diversify your portfolio with stocks, options, futures, crypto, and more from Tasty Trade. Focus on the markets that matter to you. See the odds before you trade using curve analysis, IV rank, and more tools. Get industry insights that help you find your next trade right where you need it. Tasty Trade. Download today.
New from Tasty Trade. Unlock 30 days commission-free trading, plus a 1% cash match on all qualifying deposits when you open and fund a new Tasty Trade account. The Money Match event starts now, exclusive to new Tasty Trade customers.
Frequent trips to Vegas, or there was a year I did a couple of them.
What's the most financially irresponsible thing you've ever done in your life? Doesn't necessarily have to be trading specific.
Financially irresponsible, that's a big question. Like people would say like going to college these days, I don't know. Renting, I like renting. I like the flexibility. I don't know. Maybe renting, I guess, by the book is financially irresponsible. Actually, you know what my biggest purchase right when I started my job was $4,000 on a PC setup, which was not a good idea at my salary point.
I mean, anytime you take a trip to Vegas, it's pretty financially irresponsible. I would say that frequent trips to Vegas, or there was a year I did a couple of them, which was pretty irresponsible.
When the market moves, traders need to move faster. Tasty Trade Active Trader Tool offers full depth of market visibility, one-click order entry, and instant position management so traders can react in real time. While others charge for professional tools, Tasty Trade provides them for free. Opportunity can move fast. Seize it with Active Trader. Try it now on Tasty Trade.
When you define risk, you set a limit on how much you could lose if the trade goes bad. If you have a small account, you might not be so interested in selling naked options. You'd use up much more buying power, and the risk is undefined. Defining risk, though, controls how much you can lose if the trade goes sour, and it gives you back some of that sweet, sweet buying power. We can define risk by combining options into certain strategies. The short put vertical spread is the simplest one. Selling this put sets your max profit with the credit, and the long put at the lower strike blocks off the risk where you want it. And if you're more neutral than this, you can throw on a vertical call spread to make it an iron condor. The only downside to defining a risk is that it lowers both your max profit and your probability of profit. That little compromise might mean you rest easier, though, and a good night's sleep is priceless. So see, we can define risk when we use more than one option at a time. Pretty simple.
If you missed the live show, here's our cherry on top.
Did I see a birthing room?
Birthing room?
Oh,
Yeah,
stop. Please
behind
stop.
JJ, is there a birthing room?
That's not a birthing room, you genius. Okay. Oh my God. Yeah, we have a whole birthing room. It's called. Oh my God, I think it's called a lactation room. Okay.
No, we have a birthing room. Hey, Tasty, we're delivering babies.
Feel like your wardrobe is missing something? Like style, purpose, and maybe a dancing dog? Can I pet that dog? The new Tasty Trade and tastylive web store is now live. New merch, bold designs. Did we mention all net proceeds go to one tail at a time? Invest in the real bull market, dogs. Go to tastytrade.threadless.com. Grab some gear and help some pups. You get merch, they get a home.
Explain pot odds.
Pot odds is my favorite term, but pot odds in the poker world or gambling world refers to having a greater payout than your implied odds would suggest. So let's say I have 3-to-1 odds to win a pot, but the pot is giving me 4-to-1 odds to make that bet. I would have a positive expected value over time. So in trading, let's say you have a defined risk debit or credit spread that's currently at a max loss, and let's say there's 30 days left to go. There's not really a reason to close that position because you're already at max loss. You can only go up from there. So in that scenario, that would be a positive pot odds scenario or something that would give us pot odds to stay in.
It's the day that when you write dates in the American system of month, day, year, which is a little bit funny, looks like 3.14, which is one of our better approximations. And actually, this year is even better because it's 3.1415. I've never before, but this year, there's a couple other math people who just got a pizza oven, and so they're bringing everyone over, and we're gonna make a bunch of pizzas. It's one of the few very important transcendental numbers, right? I mean, 0, 1. There's a lot of good contenders for most important number. Oh. Pumpkin. Oh, just circles are great.
Well, these markets can't seem to make up their mind. We have another head-spinning reversal to contend with, and that's not for any sort of this or that reason, apparently, because all of the macro shenanigans that could have happened today didn't. So what is it that these markets are doing, and why do they seem to have such a hard time holding up? That's what we're going to tackle here on Macro Money. This is Ilya Spivak, head of Global Macro here at Tasty Live, and we'll start as we usually do with a look at what happened in the price action and why the markets appear to be struggling to perform here. And from there, take a look at what came out on the event risk that might have inspired them today, and then see if we can't figure out what might be coming next. So let's first and foremost take a look at what these markets actually did. It was a relatively quiet day once we look at the numbers, but that belies how we got here. So the S&P down just a touch, NASDAQ more. In fact, the stock market today was kind of an interesting breakdown sector-wise where all sectors but tech were up, but tech was down, and one would, I think, be hard-pressed to find a specific catalyst as to why tech. But it certainly lost ground today. NASDAQ here with a clearly weaker showing, down almost 0.7%. Yields continue to decline, giving us a kind of negative growth lead. Bonds, again, on the upside. Crude oil continues to leak lower, but at a slower pace, down 1.5%. Gold apparently has no regard for anything that's going on anywhere and for any reason. It just continues to inch higher. The euro a touch higher, so is the yen, but only just so. And Bitcoin, as ever, doing its risk appetite on steroids thing. Stocks are down, so it is down more, off just over 2.5%. What's interesting about all of this is when we look at the sort of internal dynamics intraday for how we arrived at this juncture, we find that we have a sort of strange way that these gains and losses ended up materializing. So what's nice about this chart from the Wall Street Journal is we can really start at where the sell-off began on Friday, and there's a number of interesting things that immediately jump out. So obviously the story on Friday was that the president said something that seemed like escalation of the U.S.-China trade war, and everybody got all kinds of hot and bothered, and there was a big sell-off. Here's Monday. This is the 13th right here. And obviously, we had a massive rebound, lots of comments to calm the nerves over the weekend. The president apparently walking back some of the worst of what he said, saying, you know, Xi Jinping is going to reach the right decision. He just had a bad moment. The export controls that the president is raging about, that's just a mistake, and we'll figure it all out. It's going to be fine. That coupled with comments from Treasury Secretary Scott Bessent yesterday, today from U.S. Trade Representative Jameson Greer saying, you know how the president said that he's not going to meet with Xi later this month as scheduled? Don't worry, he is. They'll have a conversation on the sidelines of the APEC conference in South Korea. It's going to be fine. Everything's still okay. And so maybe it was even sensible to write off this as saying, okay, well, the market got afraid of a trade war, then that risk got walked back, so okay, everything's okay again. Then, of course, going into today's session, we plunged right back to these lows, only to climb back over, only to fade at the end of the day. So the markets are really struggling to find a lasting lead here. And as we can see, what's perhaps the most fascinating part of all of this is, first of all, since all of it began on Friday, we are on net down across all of the indices. So we're down on the S&P, we're down on the NASDAQ, we're down even on the Dow from where all of this began on Friday. But maybe even more fascinating still, NASDAQ has been the biggest loser. We can see here that whereas the S&P is down, it isn't down as much as the NASDAQ is, which is over 2%, and Dow is closer to flat than it is to really down in earnest. And so if what we're talking about here is a trade war, something that is ultimately a growth risk, it's very interesting indeed that the place where the most weakness is perhaps the place where that trade war matters least, in the place where you have these mega cap tech names. Because if anything is sort of relatively insulated, as we learned in spades, of course, during the COVID pandemic, if there's any place that's sort of semi insulated, as it were, from the business cycle, it's this AI narrative, because it's not necessarily linked to near-term economic dynamics, to near-term supply-demand dynamics, to the near-term business cycle. And yet that's the place where the selling is most acute. If we take a look at the biggest losers in the tech space today, it's Intel, it's NVIDIA, it's SMC, all of them kind of names, Oracle, names in the AI constellation of things. And so the trade war is, of course, a significant thing, but one wonders if it isn't more an excuse than it is a true catalyst for a sell-off that wants to happen, and for a market that's maybe finally found itself to be overdone and frothy. As far as the event risk is concerned today, we had a speech from Fed Chair Powell. He said mostly familiar things. Perhaps the most interesting bit here was that he said that we may be approaching the end of balance sheet contraction in the coming months. The Fed has been undoing its quantitative easing efforts for years now. It's always interesting to hear people say that the Fed just keeps printing money forever, when in fact the Fed has been unwinding that part of its policy response for quite a long time now. So we have perhaps a situation where that is actually ready to go the other way. So if the markets wanted to hear something dovish, here is that dovishness. So the Fed ostensibly saying here that it's ready to remove an element of tightening that it has been deploying outside of kind of the rates up or down dynamic that we've seen. And perhaps that's because, as we see from these comments, data has suggested that we have significant downside risks to the labor market. And this is, of course, a familiar narrative for how we managed to justify September's cut. In the subsequent Q&A after this, another interesting bit here saying that that sort of indeed the labor markets has softened considerably, but that the standard error on what is a neutral amount of job creation may be as much as 50K up or down, which means that we might have tremendous volatility in NFP data at this point, such that we might even get negative readings. And it's almost as if the Fed is out here trying to prime the markets for maybe we'll get a really ugly September NFP number once the shutdown ends and that number finally comes out. And maybe that's okay. Maybe that doesn't change the policy calculus for Fed officials, which of course is an interesting conclusion in and of itself. But the Powell comments didn't really seem to move the needle today. Expectations for the October cut still hovering at familiar levels, hugging the high 90s. The likelihood of a December cut doing the same thing. Obviously, it's gone up versus a week ago and certainly versus a month ago, but versus yesterday, not really a meaningful change. So Powell didn't really make a dent there. The big question, of course, still the disconnect between Fed policy expectations for next year. The market and the Fed are about on page for this year. We can see that the markets are baking in 40 basis points here, net of the 25 basis point cut that's already occurred. So if we consider what that means here in aggregate, the market has baked in essentially 40 of the 50 basis points that it sees coming. So that just reinforces that basically this is not 100% and this is not 100%. So there's a very narrow likelihood that things might get a little bit iffy relative to expectations, but obviously the market is very much convinced that all the things that are supposed to be happening are indeed baked in as expected. So, I mean, if we take a look at 39 basis points, that basically says that that we are going to get to two more cuts at these meetings, that we have 50 basis points left before year end, now carries a probability of 78% collectively as a cumulative scenario. And so if we look at that relative to Fed policy expectations, this is in fact already in the market. So the real question is this for next year, where the Fed only has a 25 basis point cut on the board, whereas the markets have the better part of 3. So almost 70 basis points here. Obviously, that's at least 50, so at least double what the Fed has, and quite a ways in the direction of that third cut. 19 basis points out of the 25 that you need, and that's a 76% chance of a third cut. So the disconnect here very much left intact in the wake of what the Fed chair said today. We can see that what's become interesting here is that stock markets are getting soggy as the outlook gets more dovish. And so this is sort of the kind of dynamic you might expect were there to be a growth scare, which seems to vaguely line up with whatever conversation might be being had out of the U.S.-China trade war conversation. That's obviously first and foremost a threat to global growth, to U.S. growth. And what you have here maybe is some sort of a recession-ish dynamic that's starting to emerge, but it could just as well be happenstance, and we might still be in an environment where the market is sort of imbued with hopium, but the Fed is resistant. One thing that's certainly seeming to take shape here is the dollar is finding reasons to continue to go higher. It went higher as the outlook got less dovish. It has continued to go higher as the outlook has become more dovish, as if to say the dollar is back to its kind of haven type of status. And perhaps what this then all lines up to is indeed some kind of a cyclical concern, because here we have all put together a more dovish view from the markets, which speaks to growth risk, a stock market that's struggling to keep going, and a dollar that's finding support all the same. All this is starting to add up to some sort of a generalized risk-off, issues ahead type of a conversation. Unfortunately, we still have this government shutdown going on, so we don't have any economic data of substance to keep an eye on to inform this story. There will be a little bit of economic data out of China over the next 24 hours. Their inflation numbers are due. The expectation is we're still going to remain in deflation mode, 0.1% expected on headline CPI and negative 2.3% expected on wholesale inflation for PPI. China has been stuck in a deflationary malaise for 9 consecutive quarters now. And the situation obviously isn't very good. It basically speaks to a near total absence of demand. So perhaps the president has figured that if ever there was a time to turn the screws, this is that time. But China is defiant nevertheless. Also on the board, a bunch more Fed speak. The comments from Fed Governor Stephen Miran might be particularly interesting. He's sort of emerged as the anti-consensus voice, and not surprisingly so, that's largely how he ended up putting on pause his post as the chairman of the Council of Economic Advisors in the White House, a post he nominally still holds, but which apparently got put on pause for now while he is serving on the Fed. And clearly he's brought the administration's voice into the monetary policy conversation. And so it'll be interesting to hear from him what he's got to say, because that'll give us kind of the full breadth of what the conversation at the Fed looks like. Powell, for his part, said that there's a very healthy debate about policy given the situation of tension between the mandates, that is to say, the balancing of keeping inflation in check while also addressing the weakness in the labor market that the Fed has identified. On the earnings front, almost all of the names on the menu today beat expectations, but for BlackRock. And the price response, which I have in this box right here, kind of a hodgepodge. JP Morgan beat but was down. Wells Fargo beat and was up. BlackRock missed and was up. So a mixed bag here, and not really a macro narrative to be had out of these earnings. It would seem tomorrow, Bank of America, Morgan Stanley, PNC keep the financial theme going. We'll get a couple other names as well. So it'll be interesting to watch how that develops. We've pointed out before here that one of the more interesting bits here from FactSet is that the market seems to be rewarding upside surprises much less than it has been historically. In fact, about a third, 0.3% versus 0.9% for the 5-year average for a standard upside surprise, whereas it seems to be punishing misses more so than average, with a 3.1% average loss versus 2.6% historically. So there is seemingly some sort of a risk-off vibe, even in just the market's response to earnings readings, but at least over the past day, they haven't given us a clear macro lead. So exposure-wise, I am still very long the U.S. dollar. In fact, I've only added on, sold some more Aussie this week, sold some more pound last week, sold some more Canadian dollar just over the past 24 hours. I've also added a little bit more exposure on the risk-off side and took the opportunity from the bounce today to put on a little bit of a put vertical in the NASDAQ. And at least for today, that seems to have been an okay idea. Still short crude oil as well. That continues to lose ground. And added a little bit to my long bond position, added another call vertical here. That continues to make headway at the long end, up a little bit more today, and seemingly attempting to make higher highs. There was a little bit of a pullback at the start of the weekend, so I used that to add a little bit. So looking for that to continue. And that is Macro Money for today. As ever, we are here Monday through Thursday, right after overtime, a show I usually co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. I'm also writing for the news and insights portion of tastylive.com and commenting at Ilya Spivak on former Twitter and on Blue Sky. If you're watching this on YouTube, like and subscribe. Macro Money will be back tomorrow. Happy trading.